What is the biggest risk factor in 2022 and how should investors prepare for it? Hello everybody, my name is Archie. I'm beyond excited to be making this video for you guys today. This is my first ever YouTube video. That is why I'm so excited. This is something I have been wanting to do for such a long time, but finally I've stopped procrastinating and I told myself to get on with it. So since this is my first video, a little bit about myself. My name is Archie. I'm currently working in the investment industry and I love the financial markets. I have gone to school to study economics and finance. I had my undergrad in economics and a master degree in finance. And I have been trading my own portfolio ever since I was in college in 2014. And I started with $30,000. Now I have a few $100,000 all from that $30,000. So you can say that the money part is definitely a huge reason why I love the markets. But in addition to that, this analyzing the markets, analyzing the financial data, the macroeconomic trends, it is definitely, I believe, one of the best things you can be doing with your free time. It is simply so interesting. It is so intellectually stimulating. I genuinely enjoy doing it. That is why I started this channel to share some of my thoughts with you. Hopefully we can grow together, make better investment and trading decisions. And I'm not here to sell any courses. I'm not here to sell you anything. I'm just here to share my thoughts. So let's delve into today's topic. What is the biggest risk factor for investors in 2022? So in my opinion, it is not inflation. I know inflation has been the talk of the town for the past, say, year or 8 months to a year or so. Inflation has been high after COVID due to a variety of reasons. Has been 7.9%, 7.5%, and has been making multi-decade highs. And in the beginning, the Federal Reserve believed that inflation was transitory, and I believe that they called it transitory for a good reason, because just like a financial model or just like any formula, if you plug in all the same input, you're going to get the same output. That is just physics. That is just law. So the Federal Reserve believed that everybody in the world was going to go back to the way it was before COVID, pre-pandemic, and that is just going to cause inflation to be low again. However, I believe they have miscalculated two things. One is that they grossly underestimated how much money they have printed. In 2008, they had rounds and rounds of QE, but to a much lesser extent than what we had in 2020. So, after 2008, we didn't see too much inflation. And they believe that, this time they can do the same thing with a little bit less reservation and they can print more money and the inflation will still be low. I believe that was their number one miscalculation. However, their number two miscalculation is a lot more severe and it leads us to the biggest risk factor in 2022. So the number two miscalculation the Federal Reserve did by calling the inflation transitory was that Federal Reserve believed that everybody in the world was trying to go back to the old ways. Now it is looking to be false. And what I mean by that. So one of the countries that's taking COVID most seriously, I'm sure that you know, is China. China, is the country in which COVID was discovered in the first place. But after COVID became a huge pandemic, China has never let its foot off the, say, gas pedal in stopping COVID. China is now pushing this zero COVID policy, meaning that if a city has, just a few COVID cases, everybody in that city, in China, each city could have, 10 million people, sometimes even 30 million people in population. All 30 million people or 10 million people, they are required. It's mandatory that everybody in that city go to the nearest testing center and get tested. And factories will get shut down, production line will get shut down until COVID in that city is completely eradicated. So this is kind of a very extreme policy compared to what North American and European countries have been taking. And US has been taking the least restrictive policy compared to Canada, Australia. And we can obviously debate which one is better, but we can all agree that China has been taking the most extreme policy among all of them. And it was just only 2 days ago that China decided to shut down Shenzhen, Shanghai. These are unbelievably big international cities. These are not your secondary towns in each province. These are one or two of the largest cities in China, accounting for large chunks of production and GDP growth. So in the past, China has been prioritizing its GDP growth, its economy over everything else, over human rights issues, over intellectual property issues, over environmental issues. So now it's kind of a little bit weird. At least for me, I found it very, very weird that China is taking this hard pivot on COVID, that is prioritizing zero COVID over its economy. In fact, it's doing the zero COVID policy at the expense of hurting its economy. So what I think is happening is that China is using the zero COVID policy as an excuse. They're using this as an excuse to slow down production, to put more pressure on the supply chain. So the Federal Reserve is wrong in thinking that everybody's trying to go back to normal. I don't think China is trying to go back to normal, because if it was trying to go back to normal, it wouldn't be doing the actions it's doing today. It doesn't make any sense. I think that the Federal Reserve believed it was transitory because they believe it's only going to be a transition, that everybody's going to eventually transition to normal. Just like, companies that, they're going to transition everybody back to the office. However, some companies are never going to transition their people back in the office. The same logic applies to China. China does not want to transition back to normal. It doesn't want to transition back to normal because it believes that the US is in a particularly weak spot in terms of currency, because it printed too much money. It's weakened US dollar. So if China has finally realized that it's in a position to push the US over the edge, into the cliff. At least that's what China believes. That's why it's slowing down its production on purpose, to put more pressure in terms of pricing in the US. And I think if you look at China's friend, Russia, what Russia is doing, clearly this is a humanitarian crisis, but I don't want to delve too much deep into that topic. It can get very complicated. But in terms of economics, Russia's invasion of Ukraine has put so much pressure on commodity pricing. All sorts of commodities have shot up in price. We have nickel going ham. We have crude oil. We have natural gas, corn, wheat, you name it, because Ukraine and Russia are both big commodity exporters. So now they're not selling the world their commodities, and for different reasons, obviously. So now we have commodity shortage, and commodities are trading higher in prices. So in the US, in North America, we are basically seeing prices going up in terms of raw commodities and manufactured goods. So these are inflations, right? But everybody already knows this. So say, hey Archie, what is the biggest risk factor? You told us it's not inflation. What is it? Now, what I think the biggest risk factor is what's about to happen next. It's not necessarily what's about to happen next, but rather what could happen next. That's why I call it the biggest risk factor. I believe the US, the Federal Reserve, will have no choice but to print money again. So you're like, hey, that doesn't make sense. When inflation is high, Federal Reserve typically raises interest rate. Today we just had FOMC meeting. They raised interest rate by 25 basis points. So, it raises interest rate to fight inflation, right? That typically is what happens. And it typically works, but not this time. So normally inflation is a domestic phenomenon. Means that, economy domestic has been overheating, and US said, hey guys, slow it down, higher interest rate, everybody stop producing so much, stop hiring so much. So, the inflation rate would go down. However, this time, as we just discussed, inflation is largely a foreign influence phenomenon rather than a domestic phenomenon. Is there a portion of inflation that's caused by quantitative easing? Absolutely. Now, how much of that is caused by quantitative easing? How much of the 7.9% is caused by foreign influence? I have no idea. I don't even believe the Federal Reserve knows. So I think the Federal Reserve is really worried that even if it raises interest rate and it hurts the economy, it's not going to bring the inflation down by a lot. That's why these days, if you hear the Federal Reserve talk, the 2 weeks ago, even including today, they're a little bit reluctant increasing interest rate, do these dramatic hikes, 50 basis point, 1%, they're definitely not doing that. They're saying that they're very data dependent. They believe inflation is going to fade. So they still, trying to push this narrative that, hey, let's not call crazy inflation rate hikes yet, and let's wait a little bit. And I think they're going to wait until China reopens. However, I think China is doing this on purpose. I think Russia is doing this on purpose to cause more pricing pressure upward to the North American consumers. But what is the end goal? The end goal is the biggest risk factor, which is a capital war. So a capital war is an idea that was, I think, originally brought forth by Ray Dalio, the founder of Bridgewater Associates. So Ray Dalio in 2018, when the trade war was happening between the US and China, at the time was Trump was president, Ray Dalio brought this idea forth called a capital war. So China is, as of today, the second largest holder of United States Treasury bonds, with Japan being number one. So China holds $1.1 trillion of the $28 trillion United States Treasury bonds. So what does it mean? So basically China lends money to the United States. Why does the United States need to borrow money? Because Americans spend a lot. So in order for to fulfill the spending need, US needs to borrow money, and who can lend the money? China. So that's how it works. So US borrow this money, and China is holding these IOUs. But the problem here is China holds too much of United States Treasury bills. Over the years, has accumulated a lot. China can sell these treasury bonds in the open market anytime. It can sell today, it can sell in 2 hours, it can sell tomorrow, it can sell next year, or it can decide not to never sell. And what would the impact be if China does sell United States Treasury bond in the open market? And what if it does in a very aggressive manner? It would immediately cause the treasury supply to go up, and in turn drop the prices of these bonds. So that would cause the yield of these bonds, so the interest rate basically of these bonds, to go up dramatically. So if that happens, because treasury bonds in the US are what known to be risk-free assets, that means on the back of these treasury yields, every interest rate would go up. Your refinancing rate is going to go up. Your if you have a business and you have a line of credit, corporate line of credit, that rate would go up. So China can actually unilaterally raise interest rate without the consent of the Federal Reserve. So China can actually do this rate hike by itself without the United States consent and completely bypassing the Federal Reserve. So that would cause US into recession, because all of a sudden US has been relying on cheap rates, cheap money, and all of a sudden if the money becomes more expensive, if the business needs the next line of credit to survive and it is unable to secure another line of credit at an attractive rate, if you buy your house on a floating rate thinking that the rate is going to be 2%, 3%, now all of a sudden the rate jumps to 6%, 7% because the treasury market has been flooded with China's selling of the treasury bonds, then there's going to be a lot of pain in the US. While at the same time, inflation is going to be high because the inflation are driven in this case by these foreign influences rather than domestic sphere. So even if the US is pushed into recession, the inflation in this case is not going to be curbed. However, I do believe the Federal Reserve is already understanding this, and I do believe the Federal Reserve is not trying to increase rate and to rug pull the market because it doesn't think much of the inflation is caused by itself. That's why that explains transitory, but it's no longer transitory because I think the Federal Reserve understands that China is playing a dirty game here and is trying to figure out how to best protect its asset prices, how to best protect its treasury bond market. So in the next video, I will be talking about how you could spot this scenario if this scenario were to happen. Obviously, this right now just a risk factor. This is not something that I'm predicting to happen. This is something that could happen. In the next video, I will be telling you how you can spot this risk from a mile away and what assets you should be buying and or selling to best protect your money in this scenario. So thank you everyone for watching. See you next time.